All right, guys. Good afternoon. Hope you guys are doing well today. 1 second. Let me get my headphones set up. Okay, there we go. Got my headphones set up. Hope you guys are doing well today. Mara dipping down to 1440s. Is this a dip buy as we speak? The actual Mara earnings call is going to be later on, but the earnings for that for Upstart are going to be live this evening as well. What's up, UB? All right, so the earnings are going to be released. Full call will be streamed here as well. Starting at 5 p.m. Eastern Standard Time for that as well. So it doesn't look like AMC held its gains here. Oh, so the earnings call is actually going to be a little bit early. Nice. The Mara earnings call is going to be at 4:30, which is honestly really nice. Get done earlier. Bullish or bearish, we're also going to be doing. All right. We're also going to be doing our daily Twitter poll. Calls or puts. You can also join us live as we do here. Again, the Mara earnings are going to be coming out after 4 p.m. Do me a favor, hit that like button as well. SOS. Yeah, crypto ramped up. I mean, that's kind of what happened here. If you look at Bitcoin hit 24K today. It's underneath it now, but you know, it's testing those highs. And so with that, we're getting some strength in crypto stocks. Oh, they might have been dropping down now. All right, team. We do have our Twitter poll right here. And again, vote on this poll. Let us know how you feel about Mara. There's the link. Yeah, we'll trade. All right, so here's the S&P. Now you can see the crypto market's mostly just following it. We might actually short the market a little bit here. There's 30 shares. Shorting into this double top, we're also approaching this previous closing price. So we might add to this all the way up to this previous closing price level and then try to scale out quick. In 30 shares of the Q, we'll go ahead and get 45 and then make it a full 50 here. 50 shares of the SPY short. We'll see if we can dip enough to take a quick profit to protect the trade and then see if we could get a dump under 413s for the SPY. Good day for me so far today. $100+ day. Get our Discord up too. Okay, we got 7 votes already. Y'all give me a follow. Hey, what's up, JJ? So JJ, man, what are you doing here with cryptocurrency? Cannabis company focused on bridging the gap between Kush and crypto. So what are you doing in that regard? How are you bridging that gap? Explain it to me, sir. And I'll give you a follow, man. Just explain to me what it is. Hey. Yeah. All right, guys. So yeah, we're short. Like I said, we might add another 25 shares. There we go. And that'll be a full position. Y'all do me a favor, guys. The like button is slacking here. The like button is slacking. Y'all hit that right now. All right, we're short 75 shares at the SPY. Short term. See if we can bump into profit quickly here. Should we buy some options into tomorrow? We got some votes on the poll here. We got 14 votes already. 50-50 split right down the middle here. You get 75 shares of the SPY here. We might add a little bit more to this. All right, we went ahead and added 100. We're in 100 shares of the SPY. Short-term trade, not a long-term trade. All right, we just took half off, 25 shares. We might add some back here if it sets up well enough. Ideally, we're just looking for a big breakdown here, but I mean, we're already up 100+ on the day. Kind of gone back and forth, especially with AMC's dip. But this is the current P&L as we speak, up about a 114 on the day. Small, but, you know, green is good. I'll take it. There we go. We'll cut a little bit more. Only 3 people here? No, we got 45 right now. We started about 9 minutes ago. We'll probably get a couple hundred at least here today, Joe. You might want to refresh your screen if you're only seeing 3 here, you know. Oh, there you are, JJ. All right, guys. So SPY pumping back up again. We might short it again if we move up here as we approach that previous closing price. There's 25. Mayor is still sitting at 1437. Again, we're gonna do a poll on the stream as well. Yeah, we're covering Upstart too. Bull or bear on Mayor earnings. All right, we got two big up wicks. We're gonna add some more to this. We're in 50 shares. Cover a little piece. Maybe add some back on a move up. 50 shares. Hey, good luck, Brian. You're getting voted the poll right now. We're pretty split on all these polls here. We got about 21 votes on our Mara poll. We'll see what we get. SPY up to 413.20s, man. And while it didn't hold its gains today, it's still a pretty good few days of the market. If we look at the last 10 days on the SPY's been pretty bullish. Again, we got Upstart earnings. We got Mara earnings today. I don't usually stream earnings on Monday, but today we made an exception just because. And so again, let me know what you guys think we'll get today. And we're going to add a little bit more to this. We didn't get to. All right, 75. All right, we're in 75 shares of the SPY short. We do have an upward trend that we got to be careful of a break. You know, again, we're up 100 plus on the day, so we're not going to lose today with this position. But yeah, we'll try to be patient. Again, Upstart earnings today too. Upstart's actually the larger cap company relative to Mara, but I like Mara because it's crypto related. Again, 55% of people on Twitter in my poll said calls, 45% said puts. Again, we're in 75 shares short of the SPY. Kind of using some profit we already built up on this one. Kind of a crazy day for stocks in general here. Here, I could put these charts a little larger so you guys can actually see what I'm doing. That might be a little bit better there. There you go. All right, I like this upwick. We're going to go ahead and add another. We're in 100 shares short of the SPY. Could add a little bit more if we want, but I think we'll just let it chill. We break this high, we'll cut it. All right, so I guess we'll cut it. We're losing about $10 from the trade. Could go worse, but yeah, it just started to ramp up a little bit. Again, we got 14, 15 minutes until the market closes. I'm not really interested in holding this through the closing bell to tomorrow. I mean, we got 100 shares, roughly a 40,000 share position plus 40,000 plus share position. So yeah, SPY at 413s. Yeah, 41,000 share position. So trying to be patient, but Mara's starting to bounce back a little bit. Mara's at 1450s. Should we cover Mara or Upstart? I guess is the question. I'm probably covering Mara. Again, I like it because it's crypto related. But it is Monday for an earnings call, which is a little bit slower of a day. Mara pumping up. Good volume just now. 60,000 shares traded. Yeah, I think Upstart's the bigger stock for sure. I also did the wrong thumbnail. There we go. All right, so we're actually green on our trade. We sat in it long enough to turn green here. There we go. Covering. 50 shares left. Covering. 25 shares left. All right, so we made a little bit of money on that trade. We were patient enough for the rejection. We're up 125 on the day. Could have done a little bit better, but that's okay. Here is the P&L. We're up $125 today. Not bad. Not bad. A few longer term trades. Yeah, we got 14 minutes until the earnings starts. I might short this again. Again, we got the SPY making big moves today too. If we zoom out on the SPY, SPY didn't really hold, but this will be interesting to see how UPST and Mara earnings. What other big earnings do we have today? I know we got a few of them, to be honest here. Y'all list them out in chat. I know this is a big week for earnings as well, though. We got today we have T2, we got BLNK, we got UPSTART, yeah, BLNK, BLNK charging stations. That's another one that's dropping today. So yeah, we got BLNK with numbers coming out today. Here's the SPY and here's BLNK. BLNK's had a pretty strong day or a few weeks leading up to this. They had the chip bill pass, and it's all going to benefit this one to a certain extent. We also had T2, Upstart, NVAX, Lemonade, Marriott. So yeah, tomorrow big day here. We got tomorrow we got Roblox. We got man, Disney, I think, is tomorrow. Disney's either tomorrow or Wednesday. Thursday is Rivian, which we're certainly going to cover. Rivian will be fun to cover. Polo tomorrow, Cisco in the morning, Kronos Group. So yeah, look at Mara rip up. It's at 1450s too. Yeah, Mara coming through. Disney tomorrow. Yeah, what's up, Chris? Roblox tomorrow. Yeah. Well, we had PLTR, which yeah, so we had earnings this morning, and every time we've tried to pronounce it, we had three different versions of how we pronounced it. Apparently they were all wrong, and so I'm just using the Google robot from now on to pronounce, and so that way I don't mess it up anymore. But yeah, BLNK up there as well, 2370s. This one's dropping earnings also. Shorting UPST into earnings, grab 50 shares. Hey, what's up, Fonz? Good luck, bro. Good luck, man. It'll certainly impact things. We'll see. BLNK too. Again, bullish or bearish on these? Let me see the poll now. So the poll we got going on has 55% saying bull, 45% saying bear. If we look on Twitter, Hey, thank you, Rogue NFT. All right, guys. So BLNK at 2370s, 2370s. Mare at 1440s. SPY still pumping up. Here's the SPY itself. SPY pushing up to VWAP here. And again, we've been shorting it on these little pops and then covering on the drops, but I don't know. Yeah, Coinbase, man. Oh, tomorrow's a big day, bro. Tomorrow we're gonna have to figure out what we want to do, whether we want to do coin earnings or whether we want to do oh wait, I got an idea. Why don't we cover both? We got Disney earnings tomorrow, right? Right? Tomorrow is Disney earnings, right? Here, we got an Upstart poll coming to Twitter too. And so follow me on Twitter if you want the Upstart poll. All right. Again, we got calls or puts on Upstart, poll on Twitter. Again, if you want to vote on that, the Upstart poll is right here. Ooh, I got an idea though. Why don't we cover both of them? Here, hold on. Let me see. All right, guys. So the SPY is at 412s. Turtle Beach is aftermarket today too. Again, 75% are saying calls on UPSD, 25% are saying puts. We got 7 minutes into the earnings drop, guys. 7 minutes. Olivia Newton-John, rest in peace. Sandy, rest in peace. All right, guys. Mara at 1440s. Again, guys, 6 minutes until the earnings go live. Again, it might be a little bit slower of an earnings day considering a little bit smaller stocks. But yeah, rest in peace to Sandy, Olivia Newton-John. SPY pumping up to 413s here. We do have Blink as well. We have Upstart too. Here's UPST. UPST all the way up to 32s. And this one might be a little bit more interesting to pay attention to. All right, guys, UPST at 3220s. We got Mara at 1440s. Y'all do me a favor, hit the like button as well. On the poll we have today, bullish or bearish on Mara earnings, 51% are bullish, 49% are bearish. We also did a Twitter poll also here. So we did a Twitter poll. Appreciate the follows, guys. Again, the Twitter poll on Mara says 54%. So it's honestly pretty similar in terms of sentiment here. But yeah, here's UPST at 32s. We got Mara at 1440s. UPSD, I don't see how UPST can have good guidance with how the economy is and all. Yeah, well, a lot of stuff has been failing. UPSD beat earnings. Yeah, I don't know, man. I think it'll be a tough road for UPST anyway. Let me know what you guys think. Getting a little bit slower of a day, but we're covering Mara and UPST this morning. Again, 3 minutes. Yeah, I'm reading. Raj, of course I'm reading, bro. I'm always reading, dude. Bro, I'm like the you guy from the TV show You. I'm always watching, bro. You know, y'all think that I don't know? I see you. I see you guys. All right, guys. Mara at 1440s. Yeah, top 3 multitaskers in the world right now, bro. I'm always watching, dude. UPST up to 3220s here. 3220s. All right, guys. 2 minutes here. 2 minutes, team, before they drop. Oh, you're about to get banned. I was, as soon as I read that, I was like, oh, this dude's getting banned. And then I saw the JK at the end. My hand was like moving over it. I was just about to click ban, and then I was like, okay, he's joking. Let me let him go real quick. I'll allow it, I guess. You know, but it was close though. It was close, bro. Good luck, guys. All right, here's the closing bell. Again, we're going to be dropping all of them as soon as they happen. Again, we got 2 minutes until they drop for UPST and Mara. As soon as they drop, we're covering them. Again, we're also going to be covering the Mara earnings report in full call live on the stream as well. UPST is up to 3230, so we're watching that as well. Okay, you're good, bro. I'm just messing with you, man. Yeah, all good, Pawn. Yeah, man, my kids start school pretty soon too, dude. So I get it. All right, team. Mara at 1440s. Earnings should be dropping sometime after the closing bell. We got everything pulled up and ready here for Mara. Conference call is going to be coming soon too. Today we also have Blink charging stations. We've got Mara, we've got Blink, we've got UPST. It's probably the biggest cap company dropping numbers today. And so Mara, UPST, Blink are the top 3. They're what we're going to be covering. Market closes right now, and the earnings should drop sometime pretty soon, guys. We'll see what we get. Again, good luck today. Good luck today, guys. Let me know if you're buying the dip on Mara. Vote on the poll as well. Vote on the poll. All right, here's the close. Again, good luck, team. All right, and here's the bell. All right, there we go. All right, so Compute North begins energization of 280 megawatt Tier 0 data center co-located at wind farm in McCamey, Texas. That just dropped. There's the closing bell. Waiting for the numbers to happen here. Again, Mara at 1450s. We got UPST at 32s. UPST at 32s. All right, guys, looking for Mara and UPST numbers to drop. All right, guys, waiting for the numbers. Nothing out yet. Nothing out yet. I see Mara currently sitting at 1450s. UPST is at 32s. Let me get this out of the way. We get nothing out for Mara yet. Nothing out. Nothing out for BLNK. Nothing out for UPST. All right, so BLNK actually dropped their numbers. So BLNK, BLNK charging station did drop their numbers. They are tanking down. They showed 164% increase in total revenue to 11.5 million in quarter 2 compared to 4.4 million in quarter 2 of 2021. Here is the BLNK results essentially right here. But yeah, BLNK is tanking down on this news here, tanking down. Still waiting on the UPSTART numbers. Still waiting on the UPSTART numbers. BLNK is all the way down to 2240s, and BLNK is an EV play. So this is going to affect other EV brands and companies. So BLNK is EV. Dude, what's it been like to put yourself out there in public like this? That would be a cool discussion. How have you changed at some point was when there's a pause. I got you, bro. Let me cover these. I got you. Good conversation. I like the topic. It's a fun topic, man. So I got you, man. Hold on one second. Let me cover it right now. We got earnings dropping, so but that's a good conversation. I like it. So just yeah, good question. BLNK is kind of break even from these numbers here. Again, if we look at BLNK, kind of break even. Nothing out for UPSTART yet. BLNK is dumping down. Let's check out UPST. UPST, nothing out. So the only one that's out is BLNK. And yeah, they dropped 164 increase, 11.5 million in quarter 2 compared to 4.4 million in quarter 2 of 21. 154% increase in service revenue, 2.2 million in the quarter 2 compared to 0.9 million in quarter 2 of 21. 5,631. All right, so yeah, here is the BLNK numbers. Here is the BLNK numbers. Still waiting on UPST. Still waiting on Mara. Mara's at 1450. Nothing out for that one yet. UPST, still nothing out for that one either. But yeah, there is the BLNK numbers. Mostly break even from these numbers, but they missed on both fronts. So they missed on EPS. They showed 41-cent loss per share, missed the 37-cent loss estimate. Sales of 11.49 million, beat the 8.6 million. So it was a mixed results for BLNK. So they had an EPS beat, or they had an EPS miss, I'm sorry, and a sales beat. In terms of guidance, I'll have to wait and see what happened on that front. Hey, what's up, Eddie? UPST at 32s here. Oh, should we cover UPST's earnings call instead? Yeah, UPST is now halted, guys, into this. Halted for UPST. So it's up over 10% Monday afternoon ahead of earnings. This is just a volatility trading pause? They said, quote, with quarter 2, we will look for updated fiscal year guidance and comments on how company may alter its underwriting and funding strategy. I might want to cover the UPST earnings call instead. Yeah, I'm going to cover UPST as opposed to Mara. Sorry, guys. We're actually going to switch it up. UPST is the bigger one, and I want to cover the bigger one for you guys. And it's also at 4:30 as well. We'll still cover Mara earnings. Don't worry. But I think it's important to cover UPST considering all the hype and anticipation around it. We're also going to cover Mara earnings report, of course. So don't worry. We're going to cover the Mara earnings report as well. So bear with me 1 second. Nothing happened for Mara. Okay, there's Mara's numbers. Mara numbers looks like it's just out. We'll cover Mara. Don't worry, Taiwan. We got you, bro. We're covering Mara. Mara numbers looks like they're out as well right now as we speak. They also posted. Okay, so Mara numbers are out as we speak. Mara numbers are out. UPSTART numbers are out as well here. Give me 1 second. We'll tell you what all this stuff is for UPSTART. All right, so here's the Mara numbers. We'll cover LMND, bro. I got you, dude. Just give me a second. We'll cover all these guys, okay? So just bear with me, team. We got this. All right, we'll cover them. We're going to cover all these as best we can. All right, there's the mirror numbers. We do have UPST numbers are out too, but we're waiting to decipher it. All right, Upstart put in second quarter revenue of 228 million. 228 million. I'm trying to see what the expectations were for it. Drop it as soon as we get it. Upstart holding second quarter 228 million is what we're showing here for UPST. Mara dipping down to 1420. Still waiting on the Mara numbers to come out. Big pop in Mara. I hate how they organize their earnings reports. Again, there's Mara down to 1420s here. Still waiting for Upstart. Upstart halted on the earnings, which is kind of crazy, to be honest. And that's the reason we're covering this one now. It's a news pending halt for UPST. All right, so Mara down to 1428s here. 1428s. UPST dropped second quarter revenue of 228 million. The second quarter loss per share of 36 cents. Again, we're covering all these as they happen. This is what we have so far for Upstart. Second quarter revenue of 228 million. Second quarter loss per share of 36 cents. Second quarter loss of 29.9 million. Again, we're going to put the Mara ones out too as we get it. And here's the UPST data so far. Looking at Mara here. All right, so Mara posted a second quarter loss per share of 175. Second quarter loss per share of 175. Yeah, it could be a buyout for UPST, I'm assuming. It could be a buyout. Mara at 1435s here. So it's a T1 halt. It's a news pending halt. Mara back up to 1450s. 1450s. Next pawn. All right, guys. Mara pumping up to 1450s here. Mara lost loss per share of 175 for Mara. 175. Down to 1430. That's a big loss. All right, give me 1 second. We're finding the rest of this data. All right, again, UPST missed. So here's the full UPST numbers. Full UPST numbers are right here. Second quarter EPST or EPS of 1 cent, missed the 10-cent estimate. Sales of 228.16, missed the 241.63 million estimate for Upstart. And who knows when this thing is going to resume? Is it T1 and T2 mean? Got you. CLOV. See, I hate, man. Honestly, I wish stocks would just tell me what's the EPS, what's the sales, what's the guidance. Like, why did I get having to post a full report, but it just makes there a lag between like reporting and what the numbers actually are for Mara, CLOV, and all that stuff. But yeah, Marathon posted a second quarter loss per share of 175. They also did a big update in terms of, so for Mara, energization of previously installed miners hosted with Compute North and West Texas Commerce after the power provider received confirmation of the tax exempt status. The total number of miners installed and awaited energization across all facilities increased to approximately 49,000 miners as of July 31st of this year. They produced 2,038 Bitcoins from the year to date through July 31st, 2022. 2,038 Bitcoin, a 58% increase for Mara. Yeah, maybe a buyout. It's certainly plausible that it's a buyout. They saw, okay, so all right, so third quarter revenue was way down in terms of guidance. Here is the third quarter revenue. We're going to add this to the end of this current up one. So Upstart sees third quarter 2022 revenue of 170 million versus 248. So that's a big miss in terms of guidance for UPST. A big miss. It's at 32 now. It's halted for a T1 and T2 news pending halt for UPST, and that's not good. Like a Polaroid picture, lightning. What is a buyout? Well, buyout's when one company goes up to another company and it's like, yo, I'll give you X amount of dollars for you to give me your company. And the other company's like, okay, deal, done. Say less. And then boom. The deal is done. It's a buyout. um, yeah, but that's kind of so here's an example. Microsoft bought Minecraft, you know. There's just a lot of other examples of it. But yeah. All right, guys. Mara actually read on the day. Now, Mara actually read on the day. UPST is at $32. It's halted. Again, a lot of people are speculating that we have a buyout. Again, the big problem with UPST here, the big problem, in my opinion, from this is that, EPS was a miss. They expected 10-cent profit per share. They showed 1-cent profit. They posted sales of 228.16, missed the 241 estimate, and then the third quarter revenue was bad. They put in 170 million versus 250 million essentially expected. Almost 250 million is what they expected. So that's bad. That is certainly not good in terms of guidance for UPST. Mara dipping all the way down to 14s as well. How does the buyout influence my puts? Well, number one, I'm gonna preface anything else with that. I don't know if it's a buyout for UPST. Just a lot of the time when they halt a stock like this, it's a buyout. A lot of the time, not always though. Not always. It could be anything here. It could be anything and everything. I don't know if anybody's buying UPST. Again, we're all speculating here on what it could be, and so who knows? But yeah, Mara at 14.15s right now. So Mara trying to come back up. And give me 1 second for Mara. We'll cover basically everything that they stated here. But yeah, with UPST, it's just a big miss for guidance. Like that guidance miss was a big miss. That was not a small miss for UPST. When they're expecting 100, when they're expecting close to 250 million and they only show 170, that's a big percentage miss. Big miss. Mara posted a second quarter loss per share of 175, and then nobody else really updated it, unfortunately. So we're still kind of waiting for Mara's EPS data to drop. And yeah, we'll see what we get on that front also. Wait, where did my Benzinga go? Oh, there it is. But yeah, nothing out for Mara yet. We got it dropped here. If you want the full Mara report, company revenue of 24.9 million for the second quarter. Okay, here we go. All right, I got the marathon numbers too, and we're going to post that underneath the UPST numbers here. We're going to try to fit it all. I don't think we're going to, but okay, we might. All right, so we got GAAPS, which is generally accepted accounting principles. EPS of 175 beat by there we go. Beat by $2. Revenue of all right. So Mara back up there still. I don't know when UPST is going to resume here. They do have their earnings call in 15 minutes, and I think everybody's going to be watching them to see kind of what happens on that end because of that. Again, we got the So here is the full numbers for all the stuff that just dropped. Again, Mara, UPST saw second quarter EPS of 1 cent profit, missed the 10-cent profit estimate per share in terms of second quarter EPS. Sales of 228.16 million, missed the 241 million, but it was a smaller miss for UPST in that front on second quarter. UPST, the big problem with UPST is third quarter revenue came in at 170 mil versus 250 basically expected. Mara posted GAAP EPS, which is generally accepted in accounting principles, of 175 per share profit, beat the $2 or beat by $2. So I guess Mara expected a loss of 25 cents. Revenue of 24.92 million, missed by 4.7. So yeah, that is the data here. That's the data. UPST is a news pending halt. Again, we're not sure why it's halting. The T3 resuming today at 4:35 p.m. So that's 5 minutes after the earnings call starts for UPST. 5 minutes after the earnings call starts for UPST. All right, guys. Earnings call starts in 13 minutes. Earnings whisper expecting a revenue of 298. Yeah. NVAX dropped numbers too. So here's an NVAX. NVAX dropped second quarter GAAP EPS of minus 653, which is, they expected 475 per share loss. They showed 653 loss per share in terms of second quarter EPS. Sales of 185.93 million, down from 298 million. So NVAX dropped pretty bad numbers too. Is NVAX halted as well? What? Why isn't NVAX moving? Does it just never move in after hours? No, that's not true. What's going on with NVAX here? This thing just didn't move at all. Is it halted? Let me see. Yeah, NVAX is T1, 2, and 3, so it's news pending for NVAX, UPSD, ZEO, HKD. Volatility halted. HKD is halted? Not for a good reason, man. But yeah, UPST at 32s here. Again, Mara back over VWAP, back over previous close. Damn, dude. Yeah, I don't know what's going on today with that stuff, guys. I don't know, man. Just kind of crazy though. Yeah, y'all check out our free Discord. Everything is free. Also, all right, guys. So yeah, who knows what's happening with UPST? This is strange. All right, guys. So Mara up to 1430s. Also, guys, I do want to show you guys about this free site that I'm using, and it has some paid options. But I do want to show you guys about this free site I'm using called Alpha Insider. Look at Mara popping up. So while we're talking about a crypto related thing, I've been using the site called Alpha Insider, and honestly, it's a pretty cool site. So it's completely free. And essentially what it does is some of them are paid, but there's a lot of free ones. You can see like this one's free. You can just click subscribe here. And it essentially helps you track what other traders are doing. It shows you their history, so you can track like what their history is. Like for instance, this guy, if we click on him, it kind of shows you what he's doing with Ethereum, and you can track his strategies. It's kind of like a chat room as well. He kind of updates you on what's going on, what kind of trades he's making, and then he announces what he's buying, where he's buying it, and you can actually see how it's tracking Ethereum. So you can see over the last week, he's up about 10.04%, and it actually tracks it live. And so it's kind of like a marketplace, but it's free mostly. Most of this stuff is free. There's paid options, but most of this stuff is free. And you can see there's a bunch of different ones here. So I can select like the best performers of the day and see who's doing the best on the day. This guy with crude oil is currently up, big on crude today. And so I can kind of track to see what they're doing. And again, it'll give me a timeline of all the trades he's making. And so it's like, if you want to see what other traders are doing, not only can you copy off of them, and again, I can't guarantee you're going to make money, but you can also kind of see the logic behind their trades, which I think is super interesting. And so again, pretty much a free site. You don't have to pay for anything. Now, there are paid options if you want to, there are paid versions. So if like you want to subscribe to some of these guys, it costs money, but most of the guys are free. And it's just a really fun site that you can use and track and see what everybody else is trading, see what everybody else is performing well on, and kind of trade that way, And again, if we go to home here, you can see like this guy, for instance, is up 1,200+% over the last 5 years. And so you can kind of track how he's making those trades, what he's actually doing. And the site's called Alpha Insider. And so again, it is a sponsor of me, but honestly, a really cool site. I've actually been using it since, they've contacted me, and I don't really accept sponsors from a lot of people. But again, if y'all want to check them out, here's the link. It's called Alpha Insider. And I'll consider it a favor if you check it out and sign up. And I think y'all are going to become addicted to it if y'all do. It's really fun. But yeah, let's see what's up with UPST. Again, people are saying UPST resumes at 35, right? 35. So Mara, Mara beat on EPS, missed on revenue. Did my headphones just die already, bro? I just got these things. We're going to swap them out here. And again, if you're on Alpha Insider, I'm going to be on there as well. If you're on them, let me know your favorite traders on there. Yeah, let me make sure you guys can hear me. Hold on, let me exit this. Again, we're going to cover it one more time, before the end of the stream about Alpha Insider and go kind of a little bit more in depth to it. Yeah, so the earnings are out, but the earnings call is going to start in 6 minutes for UPST. So the UPST earnings call starts in 6 minutes. Yeah, but I think they beat in terms of what they expected. Again, earnings matter. This is the big thing to understand. I can hear a lot of people that are like, hey, they lost money. Why is it up or all that stuff? The reality of it is it's not about how much the company makes or loses. It's not. Okay. It's about how much the company makes or loses relative to expectation. Expectations. A company can lose $300 million. Okay. But if they expected to lose $600 million, it's probably still going to go up. It's not about how much they lose. It's about expectations here. And that's all earnings. That's the stock market. It's about expectations. All right. And so don't pay attention to the actual number. More so pay attention to what the expectations were relative to the number is what you really want to see. So UPST at 32s. Oh, just a reminder, John, for that person asking how. Yeah, we got 5 minutes until the earnings call. So yeah, man. I mean, listen. I started this YouTube channel as a hobby. Originally I started day trading in like 2016, and I just got my butt kicked, man. I lost thousands of dollars, but like I was looking at it at the time, and I remember looking at it, and there was just so many gurus out there, man. And I get it, but like I got started trying to just make a free resourcing community, kind of doing the opposite of what everybody else is doing in that regard, where, I just wanted to give people a free place. At the time I was looking at a bunch of chat rooms and there were a lot of paid chat rooms and all that stuff. And I was just kind of like, well, hey, why don't I just start a free chat room? And that's what it originally started at. Beginner Trading started as like a free chat room, and it was like the simplest chat room ever, but it had like 100 people and we would hang out. We had a bunch of old people. Like I remember Rick and this dude Chi, and we had a bunch of cool people, and eventually the channel grew and I started uploading videos and it kind of snowballed from there. Guidance. Really, guidance is more important than anything else, to be completely honest. Guidance is the most important thing. A company can have a huge miss, but if they expect to rake in money, they're still probably going to go up. Honestly, and I'm going to start on this Alpha Insider site, and I'm going to start tracking my swing trades, and so this might be a site where I actually track my swing trades on, because I'm looking at some of these guys. Like, look at this dude right here, man. This guy is just killing it right now, and you got to see what he's doing here. Like, if we zoom out, this dude is making money on oil, but if we zoom out here, where'd he go? Look at this dude. He's up 819% over the last 5 years. That averages more than 100% a year. Really, it's close to 200% a year. Not quite, but it's close to 200% a year. And you can kind of see what it does. So he might be red on the month. He might be red on the week. But on the year, he's up 370. In a 5-year period, he's up 820. And so not too shabby here, man. And so you can kind of see what they're doing and kind of track their strategies, see when they're trading, what they're holding. And again, pretty interesting, man. I really like the site. I think it's a great idea. And it's just a really cool place, man. I'm going to be on that probably a lot. All right, guys, earnings coming out. And again, if you want to check it out, here's the link. John, how can we find you on that alpha site? So I actually haven't started it yet, but again, probably starting today, I'm going to be tracking my swing trades. Is what I'm going to be doing, because my swing trades have been on point. I'm also going to use it as kind of like a tracker. Like, how we have Trading View, right? But this doesn't cost anything for me. And so I'm going to also use it to track my own results, and I think that'll be useful as well, just to track my results. Again, 2 minutes, guys, until the UPST earnings drop. 2 minutes. Let me get this ready real quick. But as for putting yourself out there on YouTube, I think after a while I had to learn how to ignore criticism. You get a lot of weird people, man, that, like, for whatever reason, they're jealous or envious of you. And, they don't want to see you succeed. And so they just kind of weird and really obsessive and just kind of strange, to be honest. And so it took a while for me to learn how to ignore that. But now I just kind of ignore all of it. The best way you can respond to stuff like that is just by trolling them. So I think that's something I learned as well. But yeah, it takes a little while to get used to. It's not, it's a blessing. I love the community. We got a great group of traders here, to be honest. All right, UPST halted still. We're waiting for the earnings call. And again, y'all can hear the music, correct? Because, again, if y'all can hear the music, let me know, because that's what's going to play the earnings call as well once it starts. And we got about a minute left. Yeah, you can listen to the entire UPST call right here. Again, guys, should be starting anytime now. I'm going to close the music as long as y'all can hear the music. Your music is good? All right, nice. All right, so with that said, we're going to exit out of this because the earnings call is about to start for UPST. All right, so the earnings call starts pretty soon. Hey, nice ES. Yeah, man, I'll just stick around ES. I'm going to be creating my own profile and tracking my swing trades, because, again, I've been on point. I'm not trying to toot my own horn. I'm definitely best trader in the world right now. But my swing trades have actually been very profitable lately. And so I do want to track them on that side too. Yeah, well, y'all will be okay. If you can't see my face, it's all right. The earnings call is about to start anyway. All right, guys. All right, let me mute this. All right, so again, we're waiting for the earnings call to start. We're in the lobby. Again, they've got some, hold music playing right now, so we got to wait. Also, guys, yeah, y'all hit the subscribe button. During the earnings call, we are going to put it in sub-only mode. And again, guys, listen, everything we do here is free. We don't charge a penny for anything. We don't claim to be experts. I don't act like gurus. Everything we put out there is completely free without charging you a penny, without any paywalls behind content. The only thing we ask is that occasionally y'all hit the subscribe button, guys, especially if we're putting out free earnings calls like this to where we're not charging you anything. We're just kind of putting it out there. And yeah, hit the subscribe button. Here's the earnings call.
Please go ahead, sir.
There you go.
Good afternoon, and thank you for joining us on today's conference call to discuss Upstart's second quarter 2022 financial results. With us on today's call are Dave Gerard, Upstart's Chief Executive Officer, and Sanjay Datta, our Chief Financial Officer. Before we begin, I want to remind you that shortly after the market closed today, Upstart issued a press release announcing its second quarter 2022 financial results and published an investor relations presentation and credit FAQ. All are available on our investor relations website, ir.upstart.com. During the call, we will make forward-looking statements such as guidance for the third quarter of 2022 related to our business and our plans to expand our platform in the future. These statements are based on our current expectations and information available as of today and are subject to a variety of risks, uncertainties, and assumptions. Actual results may differ materially as a result of various risk factors that have been described in our filings with the SEC. As a result, we caution you against placing undue reliance on these forward-looking statements. We assume no obligation to update any forward-looking statements as a result of new information or future events, except as required by law. In addition, during today's call, unless otherwise stated, references to our results are provided as non-GAAP financial measures and are reconciled to our GAAP results, which can be found in the earnings release and supplemental tables. To ensure that we have addressed as many analyst questions as possible during the call, we request that you please limit yourself to one initial question and one follow-up. Later this quarter, Upstart will be participating in the Goldman Sachs Communacopia Plus Technology Conference, September 13th, and the Piper Sandler Growth Frontier Conference, September 14th. Now I'd like to turn it over to Dave Gerard, CEO of Upstart.
Good afternoon, everyone. Thank you for joining us on our earnings call covering our second quarter 2022 results. I'm Dave Gerard, co-founder and CEO of Upstart. Today, we reported a decline in revenues, which is obviously disappointing and unacceptable to us. I want to explain where this decline came from and what we're doing to address it. It may be natural for you to question whether Upstart's AI-powered risk models aren't working as designed, but we're confident this isn't the case. That in fact, our models continue to improve with respect to accuracy and risk separation. But there's no getting around the fact that a decline in revenues is a business problem that we need to address. And today we'll share with you the actions we're taking to address it. Today, Sanjay and I will discuss a variety of topics, including credit performance, loan funding, lending partner sentiment, and some of the actions we're taking right now to make sure Upstart's future is bright. I also want to share with you the progress we've made in many important aspects of our business and how they're setting the stage once again for Upstart's growth in the future. I don't want to spend too much time restating what you've already heard about the current economic climate. Given the nature of our product and our borrower, we do, however, have a unique lens into what's transpired in the last 2+ years and what may transpire in the coming months and years. We believe we're at the end of a unique economic cycle related to the pandemic that included 2 distinct phases. The first phase was triggered by a pandemic-constrained consumer spending and unprecedented government stimulus throughout 2020 and early 2021. These together drove significant improvements in consumer savings levels and liquidity, which in turn led to dramatic overperformance of credit during this phase. Our platform experienced about a 50% reduction in credit defaults compared to the pre-COVID timeframe. In the second phase, toward the end of 2021 and into 2022, this effect began to unwind as stimulus was discontinued and consumers began to travel, dine out, and spend once again. And as expected, default rates returned to pre-COVID levels, or in some cases, even higher. While virtually all consumers benefited financially from reduced spending during the early stages of the pandemic, this cycle was concentrated in consumers who received government stimulus checks, a demographic which is also more likely to be Upstart borrowers. Our risk models largely captured these effects and performed admirably, though not perfectly throughout, but I'll get to that in a bit. We believe we're now at the end of this two-phase cycle, and an important question for all of us is what's next? Will efforts to slow inflation lead to recession and unemployment? While no one knows the future, we do expect a significant slowing of the economy and a worse than normal macro for the next year and beyond. We'll speak to that as well. Our job through all of this is to ensure the future of our platform and to protect Upstart's ability to pursue our mission for years to come. Alongside our earnings release, we today shared some responses to important questions regarding credit performance on Upstart's platform. It goes without saying that measuring credit performance is vital, and it's also non-trivial. Comparing one platform to another can be challenging. Different products, different borrowers, different return targets, months on book, prepayments, hardship policies, and more. There's no simple apples to apples comparison. We believe the essential measurement for credit performance is actual dollar returns compared to the lenders or institutional investors' target at the time of origination, full stop. And today we provided this information for all Upstart cohorts going back to the beginning of 2018. The bottom line is this: our 70-plus bank and credit union partners, who typically retain loans in the lower risk grades appropriate to their businesses, have seen to date portfolios consistently meet or exceed expectations since the program began in 2018. And how have our institutional loan buyers done? Against a target of approximately 8% gross return since Q1 2018, institutional buyers have so far seen 12 quarterly vintages overperform, with 5 expected to underperform. It's important to highlight that a loan buyer who invested equally in all cohorts since Q1 2018 would have experienced a positive return on all vintages thus far, with an overall 9.8 gross annualized return. This compares to a return of less than 3% in the U.S. high yield bond index over that same period. Lastly, we believe it's not reasonable to expect above target loan performance irrespective of the economic cycle. So it's fundamentally important to separate the impact of macro conditions from imperfections in a credit model. The essential litmus test for model performance is separation of high and low risk borrowers. As demonstrated in the loss rate by grade and AUC metrics we shared today, our model is positively differentiated in this respect, and it continues to improve. In an effort to deliver unparalleled transparency and analytics, we will provide this detailed information to each of our lenders and loan buyers. Today, we're in a funding-constrained environment, which is the primary cause of our revenue shortfall. I want to share some thoughts on this situation and actions we're taking to address it. First, as we have said recently, our goal is to operate as a marketplace for credit over the long run. We want loan transactions to take place when they make sense for the borrower and the lender. And certainly, lending is a category which we'd expect to experience some volatility over time due to macroeconomic factors. Having said that, in the last few months, lenders and institutional credit investors reacted more quickly and abruptly than we anticipated. Despite the fact that our bank partners have seen consistently strong credit performance, meaning portfolios performing at or above plan across quarterly cohorts, several of them have paused or reduced originations due to fear about the future of the economy. To be clear, these lenders and institutional investors have not left Upstart's platform, but have temporarily paused or reduced their originations. As we shared in our credit performance FAQ today, we believe our models are well calibrated to the current economic environment and in fact include a generous accommodation for a recession over the next 18 to 24 months. And given funding constraints, we believe the opportunity for lenders to generate strong returns on Upstart is unusually high right now. Yet the reaction of lenders is often binary in nature, more so than we would have anticipated. As a result, we've concluded that we need to upgrade and improve the funding side of our marketplace, bringing a significant amount of committed capital on board from partners who will invest consistently through cycles. We're currently evaluating a variety of opportunities to do just that, though we expect this will take some time to bring to fruition. Furthermore, while we continue to believe that it doesn't make sense for Upstart to become a bank, we've decided it may make sense to at times leverage our own balance sheet as a transitional bridge to this committed funding. I acknowledge that this is a shift relative to what we planned and communicated earlier this year, but a changing and volatile environment suggests we need to be flexible and responsive in our approach. We're taking this step for a few reasons. First, there's an obvious information asymmetry where we understand better than anybody how our model is performing today and how well it's calibrated for the current economic environment. Secondly, we believe the opportunity to generate outsized profits on our platform is unusually high right now. And third, we can bring a level of stability to our business that's important to our longer-term goals while we work to put these committed capital structures in place. Sanjay will share some more about this in his remarks shortly. I want to also highlight that we're building a business that can survive and thrive through a variety of market conditions to make sure we achieve these ambitious long-term goals. Our fixed costs are low and our gross margins are strong, so we can continue to invest in our roadmap and in our future through a variety of macro environments. We continue to make rapid progress in the newer parts of our business, and we're optimistic that this progress is setting up the next stage of growth for Upstart, which I'm sure you're all looking forward to. First, we continue to add new lenders to our marketplace with a total of 71 banks and credit unions as of today, up from 57 when we last spoke to you in May. Despite the cautionary outlook in the financial services industry, forward-thinking banks and credit unions continue to choose Upstart. We now have 640 dealerships using Upstart auto retail software. And just a few weeks ago, industry analyst Automotive Market Data declared that Upstart was the nation's fastest growing auto retail software provider in the second quarter. Subaru and VW were the latest OEMs that announced support for Upstart auto retail, joining Toyota, Lexus, Mitsubishi, and Kia, as well as top franchise dealers from 37 brands, including Ford, Honda, and BMW. We also expanded our auto retail lending product out to 29 dealerships and saw the first $10 million in retail loan originations in the second quarter. In just the last couple of weeks, we merged our machine learning model for automated income verification, originally developed for our personal loan product, into our auto retail lending flow. We expect this improvement to more than double the percent of applicants for whom we can now automatically verify their income. I'm also pleased to announce that we quietly launched our small business loan product at the end of June, well ahead of schedule. We've already seen some more than 40 small business loans originated, totaling more than $1 million in principal in just a few weeks. That team is quickly ironing out operational issues with an eye toward rapidly expanding this product in the coming months and years. Lastly, the small dollar loan team launched support for Spanish-speaking applicants, another giant step towards serving those left out of the country's mainstream financial system. Some of you have questioned whether Upstart veered too quickly into lending to riskier borrowers in 2021 in order to grow in our post-IPO phase. But I believe we have done exactly what we set out to do and what we said we would do. Upstart's mission is and has been to leverage modern technology and data science to improve access to affordable credit. There are tens of millions of Americans who deserve access to reasonably priced credit from our nation's banking system, yet are denied access through no fault of their own. We're unique among our fintech peers in that we aim to tackle this problem directly. The terms non-prime, near-prime, and subprime, these are words the industry invented to describe people that our current systems don't understand. The truth is that the vast majority of these Americans are entirely creditworthy. Upstart's mission is to identify those borrowers and provide them with access to affordable credit, and we haven't wavered from that challenge. How does growth fit in? We approach our business as a waterfall of priorities, in a way analogous to structured credit. Upstart's highest priority, our A bond, if you will, is credit quality. Our goal is to reliably deliver the return the lender or investor expects for a specific allocation of risk. Our B bond, or next highest priority, is unit economics or gross profits. We don't strive for loan transactions that lose money for Upstart and generally seek to avoid them. And finally, whatever is left over goes to platform transaction growth, our residual, so to speak. In truth, growth isn't a specific target for us. It's a plug based on our waterfall of priorities. The reasons for this ordering are clear. Without strong credit performance and solid unit economics, growth over the long term would be unsustainable. To close, I want to acknowledge that we've experienced some setbacks in our business, but our fundamental economic engine is strong. Our risk models are better than ever, and I'm confident that we'll be on the growth path again soon. We're taking decisive action to bring committed capital to Upstart. And to those who say that we should focus on the traditionally prime market, I say that there are plenty of others focused on that. Improving access to credit for all Americans is too important to go ignored, and Upstart has the right stuff to get it done. Thank you, and now I'd like to turn it over to Sanjay, our Chief Financial Officer, to walk through our Q2 financial results and guidance. Sanjay?
Thank you, Dave, and thanks to everyone for joining. The environment we're operating in has continued to evolve rapidly since our previous call. Industry data shows a general rise in delinquencies across all segments of unsecured credit, disproportionately impacting the higher risk tiers that have comprised a significant component of our borrower base. The impact of this dynamic on the credit performance of Upstart loans can be seen in the supplemental credit performance information that was released today together with our investor materials. The macro uncertainty and the impact of economic stress on consumer delinquencies have led to a decrease in available funding for loans on our platform, which has become the operating constraint of the business. While today's results are in line with the preliminary numbers we pre-announced on July the 7th, I will quickly call out the key financial headlines. On the top line, origination volumes and revenue from fees were both down from last quarter and below our internal expectations, driven primarily by funding constraints in the capital markets. While profitability was also below guidance, we began to systematically improve unit economics in the second half of the quarter and have pivoted to optimizing for in-quarter cash flow generation, which will carry over into our third quarter contribution margins. Following our recent share repurchase authorization, we have repurchased approximately 4.4 million shares of Upstart, totaling $150 million in repurchases. Additionally, we sold a meaningful amount of the loan assets from our balance sheet in Q2 in order to fortify our cash position. With these dynamics in mind, here now is a more detailed summary of our numbers. Net revenues in Q2 came in at $228 million, up 18% year over year. Revenue from fees constituted $258 million of that amount, representing 113% of overall revenue, and up 38% year over year, but down sequentially 18%. Net interest income was a negative component of net revenue this quarter, as we entered into multiple loan sale transactions, some of which incurred a negative fair value impact, and as the valuation marks of our remaining loans continued to be negatively impacted by the rising interest rate environment. The volume of loan transactions across our platform in Q2 was approximately 321,000 loans, up 12% year over year, and representing over 233,000 new borrowers. Average loan size was up 5% over last quarter, largely owing to auto loans representing a higher proportion of the mix. Our contribution margin, a non-GAAP metric, which we define as revenue from fees minus variable costs for borrower acquisition, verification, and servicing, was flat sequentially at 47% and 200 basis points ahead of guidance. Without the inclusion of the fledgling auto loan volume, our contribution margin for core personal lending would have risen to 51%. As we optimize our fees and marketing spend for lower near-term volumes, we expect that unit economics will continue to show meaningful sequential improvement. Operating expenses were $260 million in Q2, down 5% sequentially. We reduced our sales and marketing by 21% sequentially, as we downsized our marketing campaigns to reflect our constrained funding supply. Engineering and product development grew 14% sequentially and remains our priority area of investment, although by the end of the quarter we had slowed down hiring significantly and concentrated most of the remaining hires into key technical roles. Growth in general and administrative spend grew 8% sequentially. Taken together, these components resulted in Q2 GAAP net income of negative $29.9 million. Adjusted EBITDA of $5.5 million contracted 91% Q on Q. Adjusted earnings per share for Q2 was 1 cent based on a diluted weighted average share count of 93.3 million. We ended the quarter with $790 million in unrestricted cash, mildly up from $758 million in Q1. Our balance of loans at the end of the quarter was $624 million, of which $484 million represented R&D loans, principally in the auto segment. While our balance of core personal loans at $140 million was only marginally down from Q1, we did sell a significant number of the loans that had accumulated on our balance sheet subsequent to the end of Q1, but prior to our earnings call in May. Earlier today, we published some key data regarding the credit performance of Upstart loans. Just to recap a couple of the key points. Our models continue to provide around 5 times the amount of risk separation than a credit score, and the statistical accuracy of our models continues to improve. This has not changed. Most vintages from 2021 will underperform their return targets. This volatility comes on the heels of vintages significantly overperforming targets for 12 consecutive quarters. Despite this latest volatility, an investor who invested equally across all Upstart cohorts would expect a 9.8% unlevered gross annualized return. Notwithstanding the performance of the credit, we must confront the fact that the largely uncommitted nature of our third-party funding has proven inadequate to the task of navigating the current market turbulence, and we have turned our efforts towards building a more resilient funding model over time. Despite not having suffered any adverse loan performance, some banks are moving to limit their overall exposure to unsecured lending. Investors who've earned significant excess returns during the benign cycle of the past few years are now anxious over the state of the economy and wary over the future prospects of less affluent borrowers, who have been the most impacted by the termination of the stimulus. Despite significant conservatism in our current underwriting and the prospect of historically high returns, investors have been reluctant to re-enter the fray. Consequently, our intention is to significantly increase the fraction of forward committed capital deployed on our platform through partnerships with investors that are comfortable investing through cycles with an eye toward longer-term outcomes and in exchange for predictable future access to yield. As Dave has said, this will not happen overnight. In the interim, we are prepared to be more proactive with our own balance sheet operations if we deem it necessary to provide a level of stability for the business in this transitional period, as well as to demonstrate our own confidence in the models to the funding markets. Please note that this does not represent a change in permanent strategy, and we continue to maintain the view that it is not in our long-term interest to run a large balance sheet or to become a bank. However, in the context of the current extenuating circumstances, we will be flexible in determining whether a temporary change in tactics around balance sheet usage would be in the best interest of supporting the business through to its next state. Given the volatility of the current funding environment and the difficulty in forecasting the timing of changing macro sentiment, we feel it is prudent to limit our guidance for now to the coming quarter and withdraw prior full year guidance. With that, for Q3 of 2022, we are expecting revenues of approximately $170 million, representing a year-over-year contraction of 26%, contribution margin of approximately 59%, net income of approximately negative $42 million, adjusted net income of approximately negative $9 million, adjusted EBITDA of approximately 0, and a diluted weighted average share count of approximately 85.5 million shares. Our gratitude and admiration once again to all the folks at Upstart who are remaining resilient through the choppy waters that we are currently navigating as a company, and who remain as focused and with as much conviction as ever about the purpose and opportunity before us. With that, Dave and I are now happy to open the call to any questions. Operator, back to you.
Thank you. If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. And if you're using speakerphone, please make sure that your mute function is turned off to allow your signal to reach our equipment. Again, press star 1 to ask a question. And we'll pause for just a moment to allow everyone an opportunity to signal for questions. And we will go first to Simon Clinch with Atlantic Equities.
Hi, everyone. Thanks for taking my question. I was wondering, Dave or Sanjay, if you could talk a little bit more about how you actually go about sort of refocusing your institutional investor base to sort of longer term investors, and I guess how long that might take, and a sense of the steps that you need to take to achieve that goal.
Hi there. Sure. This is Dave. I'll give a quick answer, and then Sanjay may want to chime in. Sure. So essentially, you know, the nature of our agreements today, by and large, are at-will agreements where the volume that any particular entity is originating or purchasing is decided on a month-by-month basis. And we're talking about instead about structures where there's committed funding over a significant period of time, many months or even years. And really that's, you know, in return in some form for access to yield over that period of time in some form of economics that makes sense for those entities. So we don't have more specifics to share than that, other than certainly I think a lot of marketplace businesses in many different types of industries take actions to effectively secure inventory on their platforms one way or another. And we've decided this is just necessary for us, and so we're beginning the steps toward getting that done.
Yeah, I'll just add, Dave, that this is Sanjay. I think that we have demonstrated and will be able to demonstrate, certainly as we go through this cycle, pretty attractive long-term yields for anyone who's willing to hold and invest through cycle. And Dave cited some of those numbers, and we've got some of those in the releases we provided. And so, you know, I think there's a class of capital provider out there for whom access to that would be attractive, and you know, those are sort of you know, more arrangements that will take a while to put into place. But you know, I think that, you know, predominantly what we have today are capital providers who are, you know, vintage by vintage, and in some sense may depend on either leverage or liquidity for the ABS markets, which creates more volatility. So I think now that we have some proof points which demonstrate what yield looks like through a cycle, you know, we will use that to enter into negotiations and arrangements with partners that are more of the style of, you know, wanting predictable stability in terms of access to yield. And so I think that's all we really have to share at this time. As Dave said, these aren't going to happen overnight. They're pretty complex relationships, but you know, I think we're all very convicted that that's the direction that will provide stability for our platform to get to the next level of volume.
Okay, all right, that's useful. And just as a follow-up, Dave, I think in your opening comments, you mentioned your views that you know, we're heading for a significant slowdown in the near-term recession in the next so-and-so months, and I guess a slower economic growth outlook beyond fiscal 23. And I was wondering if you could expand on your thoughts there, and I guess sort of what you're seeing and what gives you that much bleaker outlook than perhaps I've heard from others.
Yeah, sure, Dave. I wouldn't say that it's my outlook per se. I'm definitely not a macro forecaster, and Upstart does not try to hold within its skills, you know, kind of a crystal ball about the next phases in the economy. What I was trying to state, though, is that we try to build in what you would think of as some form of market consensus, where the market thinks the economy is going to go, with a degree of conservatism sufficient for, you know, banks and investors and credit unions, et cetera, to feel comfortable on the platform. So we necessarily take what you might consider a conservative viewpoint on them, only because it's a good starting point for those who are on the platform with capital at risk. It doesn't necessarily mean it's my personal outlook or Upstart's personal outlook. It really is just trying to reflect a reasonable and a conservative take on where the economy could be in the next couple of years.
Great, thanks. I'll jump back in the queue.
And we'll go next to Mike Ng of Goldman Sachs.
Hey, good afternoon. Thank you very much for the question. I just have two. First, could you talk a little bit more about the fee revenue as a percentage of originations? It was quite strong in the quarter. I was just wondering if there were any specific drivers that led to that increase, whether those are price increases or the loan mix. And then second, just on the guidance for the third quarter for $170 million of revenue, could you just talk a little bit about the mix between fee revenue and net interest income, and any notable points around fair value adjustments? Thank you.
Sure, Michael, this is Sanjay. Sure, on the first question, can I presume you're sort of talking about take rates? When you say strength, yeah, you're talking about, okay. Yeah, I mean, I think it's as simple as, and I think we've signaled this in the past, we've typically been optimizing for not interim cash production, but sort of long-term volume in how we price. And so our take rates have generally always been at a level where, you know, we are able to produce more volume that will lead to model acceleration and learning, and will lead to, you know, future value in the form of repeat loans. And obviously, in a situation like we're in today, where we are funding constrained and we're much more focused on in-quarter cash generation, we've sort of set, you know, our fees at a more optimal level, if you will. And so we've priced them higher, and that has the effect of creating a more resilient in-quarter P&L. And so that's, I would say, just an artifact of how we're managing the business through the choppiness that we're experiencing in the market. And the second question really was around the guidance and fair value in particular, I believe. I mean, I think most of our revenue is an expression of transaction volume and fee revenue. There still is some downside in terms of fair value. We disclosed in our investor materials the size of the balance sheet we're holding, which is pretty much on par with last quarter. And to the extent there's more interest rate exposure, if the rates continue to rise, those will necessarily depress asset values and create some fair value exposure. But we're not making, I would say, large assumptions one way or the other about macro variables. We're really, I guess, trying to express the direction of transaction volume and the consequent fee revenue.
Great. Thank you for the thoughts, Andre. That's very helpful.
Thank you, Michael.
And we'll go next to Andrew Boone with JMP Securities.
Hi, guys. Thanks so much for taking my questions. As we think about you moving more loans onto the balance sheet, can you help us understand the guardrails that you're thinking about? Understood it's still early here, but how do we think about just what's the potential for using the balance sheet? And then as you talked about lenders and just the attractiveness of yields that are available right now, can you talk about just how you're educating your partners to be able to step back in? How can you proactively have them come back? Thanks so much.
Hey, Andrew, this is Dave. On balance sheet usage, I would just say, first of all, we will most certainly be prudent in usage of our cash in any way. As Sanjay said earlier, it is not our intention to become a large balance sheet lender whatsoever. Our long-term strategy hasn't changed. We aren't becoming a bank, but certainly we see ourselves in a transitional phase where we are recognizing the need for permanent or more committed capital on the platform. And as a bridge to that, we want to have the freedom to do the right things at the right time to get from here to there. It doesn't really change our overall philosophy, but nor do we think it's great at this time to have sort of a litmus test of not using our balance sheet whatsoever. We have a lot of cash on our balance sheet, and we want to use it to the advantage of the business over the long haul. So, but for sure, we're a company that has always been very much capital efficient. As a private company, what we raised very modestly compared to others, how we used it. We've been profitable most of our time as a public company. So I think we have the genetics of a company that likes to be cash efficient, and we certainly will do nothing to put our operational capacity at risk or our business at risk with our balance sheet, irrespective of whether or not we choose to use some of it within the marketplace. Sanjay, do you have anything to add to that?
Yeah, I mean, I guess, sure, Andrew, I'll just reiterate, it's still our intention in the long term to be a platform that, decisions third-party capital. We don't want to be in the business of being a balance sheet. Now, as you've seen, we're sort of signaling a contraction in our guidance. We recognize that we need less at-will funding, more committed funding, and to get us through to that point. I think what we're expressing is not so much an intention as a need for flexibility in making that transition. But as Dave said, we've always been very careful stewards of the capital that are on our balance sheet. We've always run very lean as a company. So this is really more about just making sure we have stability of model in order to make that transition. And then there's the second question you asked is how are we engaging the capital markets and the funding markets in order to provide them this comfort? And there's a couple of ways. Certainly the amount of information that we've provided to the broader public in the form of the so FAQs and the blog posts and the additional investor information we've released today, we have a much deeper level of information that we take to the funding markets. And in fact, in the same way that we hold sort of a conference broadcast in order to discuss business results with the equity markets, we're going to have a similar construct with the funding markets. And so, we do have, I think, as much or more information about anybody as the current direction of delinquencies and in very real time, and we're going to do our best to express that. And then part of this goes back to your question on balance sheet. In some sense, that the markets would like a signal of confidence in the way that the loans are currently being priced and in the macro assumptions that they've talked about. And using our balance sheet to some extent as a signal, I think can provide a lot of comfort to the funding market. So that's something that's not lost on us, given the asymmetry of information that we have around how the models are calibrated and how the loans are currently trending.
Thank you.
We'll go next to Ramsey El-Assal with Barclays.
Hi, thanks so much for taking my question this evening. Can you give us some color on what you're seeing most recently in the business quarter to date in July?
Yeah, hey Ramsey, this is Sanjay. Are you referring to any particular aspect of the business, meaning the financials, the sort of volume, the credit performance, or just a general sort of overview?
Candidly, it was quite general.
Oh, okay. I mean, I think the best expression of what we're seeing to date in the business is, it's sort of reflected in our guidance, if you will. I think that as we've said, there's a continuing contraction on the top line, which is evident to anyone, and I think that's probably the headline for what we're managing through right now.
And would you characterize that as having gone down and you're sort of seeing some stability in performance at this point, or is it still something where you have relatively limited visibility as trends are sort of maybe unstable and still sort of on the move?
When you say performance trends, are you referring to credit performance or?
I am referring to credit performance, but also I guess in addition, perhaps like the demand environment.
I don't think there's too much to comment on with respect to the demand environment outside of what we're signaling with guidance. I think that's probably the best reflection we have of it. With respect to credit trends, I would say this: the macro environment remains very fluid, obviously, and it's something that I think is changing month by month. And so I would characterize that as continuing fluidity. I would say with respect to how our model is sort of consuming and predicting the future, I think there's been significant recalibrations in our model since the beginning of this year. So when you therefore look at how the loans are performing against how they're being priced, I think there's pretty big changes in those curves, maybe starting as sort of recently as January or February. And so due to that, I think that the model has very much recalibrated to where the macro is. And as Dave said, in terms of how it's thinking about the future, there's significant conservatism in the assumptions around, what will happen in the macro. And we don't have any specific, knowledge or ability to forecast the macro than you or anyone else has. But with what we have and the trends we're seeing, I think that you could say that the assumptions are very conservative.
Got it, Sanjay. Thank you very much.
Okay.
And we'll move on to our next question from Pete Christensen with Citi.
Good afternoon. Thanks for the question. To Dave, as it relates to the relationship with the Cfpb, can you just walk through some of the changes that have been there? I know there's a bunch of nuances, but if you can give your take of how that relationship is moving. And then my second question is, as it relates to the 3Q guide, are there any assumptions that there'll be ABS issuance in the quarter? Thanks.
Sure. Thanks, Pete. I'll take the first question. I'll let Sanjay handle the second one. We continue to have what we consider to be a great relationship with the CFPB. We've had that relationship since the very early days of the company through 3 different administrations. We have a lot of history with them. We consider it constructive. We've always been very transparent and forthright with them. As many know, we had this form of a no action letter agreement that started way back in 2017, renewed in 2022. And a few months back, we requested to terminate it early, really in the sense that it was mission accomplished. It had done what we hoped, and in terms of getting a lot of feedback from the CFPB on how to properly test for fairness in a sort of modern lending model. And so through a lot of period of times and years, we built what we consider to be very sophisticated forms of testing that we do on behalf of all of our bank partners. So we have a continued strong relationship with CFPB. That structure of no action letters, et cetera, is something the CFPB internally decided they want to move away from. So I think that's okay by us. As we said, we felt in the early days of our existence and before we had really refined how to do fairness testing right, it was very useful. But today we continue to believe we have state-of-the-art fairness testing. We do that reliably on behalf of all of our lending partners. And we do continue to have open communication with CFPB and would expect to do so in the future as well.
Hey, Pete, this is Sanjay. To your second question, there's no explicit assumptions we're making with respect to ABS issuance in our guidance. We continue to issue regularly. Obviously, the execution in the market right now is quite volatile, but we don't have an explicit assumption on what that looks like or a dependency on it.
Okay, thanks, gentlemen. I'll get back into queue.
Thanks, Pete.
And we will go next to Arvind Ramnani with Piper Sandler.
Hi, thanks for taking my question. Just a couple of questions. As you're deciding to use your own balance sheet or use your banking partners for some of your loans, what are some of the trigger points you all will use to kind of make that determination?
Hey, Arvind, this is Dave. Let's just say, we don't have specific trigger points per se. What we just want to really have is flexibility. I think being able to transition from one state of our funding supply to another is one we want to make sure goes smoothly and with some confidence and just in getting from here to there in a way that's not disruptive to our partners, to our employees, to anything else. So we don't have any definitive trigger points other than we absolutely intend to be cautious and prudent with the use of our cash. We are confident that there's real profits available on our platform today. So, for that sort of basic reason, it makes sense for us to do so. But it isn't our goal to build a giant balance sheet, and it's certainly not our intention over time is to sort of switch toward that form of a business. We do believe it makes most sense for us, for our employees, for our shareholders, for all of our partners to have some flexibility in how we navigate through a pretty unique economic time that we are sitting in today.
Yeah, that's helpful. And is that something that you will sort of plan to communicate to investors, as you look to expand the balance sheet, or is it kind of going to be part of the regularly scheduled earnings calls if you plan to go that route?
Hey, everyone, this is Sanjay. I think it'll make be a component of our regular communications with the market. I don't necessarily foresee anything that's so extraordinary that would require an interim communication, but if there is, we'll certainly make it. But just as an aside, Arvind, I don't know if you've seen it, but we are sort of breaking out the balance sheet and the exact components of it in our investor materials now. Yeah, I did see that. And then just one of the things that you talked about certainly was, how you continue to see a models better equipped to price loans
And I know in prior earnings calls you've talked about some banks preferring to use UPSTART versus like a FICO score. But are you seeing similar validation through your partners that may sort of ease up the funding sources? In terms of like sort of really validating that your models are better to price loans and to shift volume your way?
Well, Arvind, one of the things that we've kind of tried to make pretty clear is that, the 70 plus banks and credit unions who tend to originate and hold the prime end of the credit have all done really well through all parts of the cycle, if you will, and have actually performed at or above expectations. So I don't think we necessarily need any more than that. Some of them have stated it publicly, and we can see it in the data and have shared the aggregate data. So I think that that's all a very good thing. But I think a lot of the issue out there really is about what may happen in the next year or 2 years, and everybody has the right to have a different opinion about that and take actions based on that opinion. So that's part of of course the challenge is it's about the future, not about exactly what's gone on in the last year or 2 years. And in that sense, that's why we have sort of said we want to move toward investor relationships that have a long-term approach, a through cycle approach toward investing, and that will be in the end lead to a much stronger platform for UPSTART.
All right, terrific. Thank you very much.
Thank you.
We'll go to our next question from Vincent Caintic with Stephens.
Thanks for taking my questions. I have two. First question, so on the balance sheet usage, so I appreciate your comments on that. And if you could talk about your balance sheet strength. So you've got over $900 million in cash. And I guess if you were to leverage that, conservative leverage, maybe you could do $2 to $3 billion of originations to support the business in the interim. And so I'm just wondering if you can maybe talk about some of the guardrails or some of how you're thinking about the balance sheet usage. And then relatedly, I think you spoke about in a prior press release about selling some of the loans that were on the balance sheet. If you could talk about how that performed. I see there's still about $600 million this quarter. How did that go, and what was the the par value? Thank you.
Hey, James, this is Sanjay. So just to maybe put some parameters on our balance sheet, that's correct. We have sort of about $900 million in restricted and unrestricted cash. I would say we have about probably $400 million of loan equity on the balance sheet and about $600 million of assets. So maybe about $200 million of that is financed. That will. We don't have an intention of getting into large amounts of financed loans. So numbers that you alluded to on the order, and I don't think it would be anything approaching that. I think it would be much more modest. This is an environment in which average and candidly, it's not readily available these days at reasonable prices anyway. So, I think of our loan balance sheet sort of flexibility as being, denoted in values of maybe a couple $100 million. With respect to loan transactions, I would say transactions, the main force of gravity on those is what's going on with rates in the environment as you're transacting, and most of the transactions we've had have been older vintages, so vintages that have accumulated maybe in Q1 of this year, and 6 months later, interest rates have gone up. And so to the extent that they have executed below par, and we've indicated that has created some of the negative fair value pressure in our P&L, it's really a function of the fact that some of the more seasoned loans have just been impacted by the interest rate environment this year.
Okay, thank you for that. I appreciate it. And one question, just following up on guidance, just if you could talk about so the $170 million in revenues. If maybe you can talk about the cadence of that, like are you seeing an improving performance as we go through the quarter? And
on the contribution margin. So I'm calculating 59%, so a nice expansion there. Just wondering what would be driving that. Maybe maybe less marketing expense or more efficiency. If you could just talk about that. Thank you.
Sure. Yeah. I guess in terms of the guidance, we're not really telegraphing any directionality. I would say things are volatile right now, and so that's more of a level than a trend, if you will. With respect to the contribution margins, yeah, I mean, it's sort of a bit of what we referenced earlier, which is, when we're in a period of contraction like this, we optimize for in-quarter cash generation. And, candidly, it's one of the important, economic characteristics of the business, which is we're essentially suffering or sort of telegraphing a roughly 50% contraction between our forward guidance and what we did last or in Q1. And yet we can weather that with, still guiding to a break-even EBITDA. And the reason is because we have quite a bit of control in terms of, our ability to set fees. We tend to be inelastic and below optimal fee levels in normal times, and so we can raise them to buffer volume contractions. And as you said, when we have less funding availability, our marketing programs, we tend to sort of keep the more efficient ones and discard the more experimental ones. So as a result, our take rates go up, our acquisition costs tend to go down, and it creates a margin expansion, which in some sense tends to push against the volume contraction, and it allows us to be somewhat resilient as a business model.
Okay, very helpful. Thanks very much.
Mm-hmm.
And we'll go next to James Faucette with Morgan Stanley.
Thank you very much, and thanks for all the detail and supplemental information. I'm wondering, when we look at kind of your expected returns by quarter, et cetera, is that you're showing that you expect a pretty significant improvement on the cohort from Q1 22 versus Q3 and Q4, even though the total or the target gross return is similar or even a little bit lower. Can you talk a little bit about the changes that were made for that Q1 22 and that are driving your expected return higher versus what was being done in the second half of last year?
Yeah, hey James, this is Sanjay. Sure. I mean, the simple version is you're seeing the model recalibrating to the changing environment, and in particular, I think starting by Q3 of 2021, the delinquency trends in the industry started to rise, and it's been disproportionately, I say, borne by the less affluent borrowers, if you will. And so our models observe that and react to it and change pricing as that is happening. And so in some sense, because that trend had happened between Q3 of 21 and early this year, maybe call it Q1 or Q2 of this year, our model has been reacting to that, adjusting, recalibrating. And on top of that, we do what you might think of as a manual overlay, which is we have to make some estimate of what we think the future macro holds, because that's not something that's in the training data for our machines. And so in addition to the model recalibrating to loss trends as they change, we are making more conservative forward predictions of what the macro will sort of do in the future. And we're to the point now where I would say our macro accommodation is fairly conservative in terms of what we're expecting to happen. Or maybe expecting is the wrong word, what we're prepared to happen in the macro given inflation and unemployment, et cetera. And so those are really the two variables that are changing. It's the model's estimate of loss depending on, as a function of the changing actuals, and it's our forward prediction of how to prepare for continued macro volatility.
Got it. And then, when you talk about looking to add committed capital and expanding that range of partnerships and agreements, what's your expectation for what that's going to do on cost of capital and what you would need to do, if anything, and if there is an impact, what you would need to do around fees and those kinds of things? Just trying to figure out like what you may have to give up in order to achieve that longer, better or stickier capital, I guess?
Yeah, it's a great question, James. I would say that on the one hand, it will make, notionally, certainly to a capital provider who's committing capital forward, there's cost for that. I think it'll make capital on the margin more expensive in good times, but maybe on the margin less expensive in times like now, because they're investing through the full cycle. And the other variable is that, as we sort of talked about in some of the other questions, we are quite margin rich, and so we ourselves can trade off economics in the good times for economics in the choppier periods in the next economic cycle, such that the investor is whole and we're creating more stability for the platform. So I think to the extent the committed capital is more expensive in a benign period, we can offset that through our own business model and then make it up when there are down cycles, as there inevitably will be. So we view our margins to be a lever that we can use to make sure that the investors are stable and the platform is stable and the borrowers are getting some amount of stability, even though, as you know, our mission is to fundamentally lend to the proportions of the population which notionally are riskier.
Great, thank you.
And we'll go next to Schindler of Bank of America.
Yeah, hi guys. I think a lot of my questions have been asked already, but one thing I wanted to go over, two things. One, you said that you're going to go out to lenders and you have now a cross-cycle vision of your performance. Are we really cross-cycle? Are you modeling that this is the bottom and we've turned the corner on kind of the low-end consumer? That is contrary to what most of our economists are saying at this point. So I want to just understand what you mean and whether or not you think that these delinquencies are going to get worse from here or better. Finally, also, I'm a little confused on the back and forth of the balance sheet, no balance sheet, using the balance sheet, not using the balance sheet. One, why this oscillation? And two, how much do you really think that you're ever going to get to on their balance sheet? I mean, originally you were saying you're going to be only about 5%, and that's for experimental purposes. I think in Q1 you got up to 15, and you said you would go down from there. A lot of that was experimental with auto anyways. And now you're saying you're going to go onto the balance sheet again. What kind of level do you think makes sense? One final question on top of that, and sorry for the three, but who are these investors that you haven't talked to? Who are you going out to kind of increase your supply? Just, are they people that don't do personal loans? Are they people that are new to this market? Who is out there that you are trying to evangelize the product to on the supply side? Thanks.
Hey, Nat. Sanjay, I'll take your first question, and then Dave and I will rotate on the last two. The first question was about, do we really think we're past the bottom of the cycle? I think in a short word, no. But I'll just give you our view on a couple of different nuances. So first of all, I do think that what's happened to date, while in the aggregate, I think that maybe there's a view that it hasn't been too bad to date, and there's more to come. I think the picture is sort of a little bit different in a nuanced way depending where you are in the credit spectrum. I mean, if you look at the industry data, if you're a very affluent borrower, and you talk about like what has been the best sort of credit performance in the last year, sort of mid 2021, and where are you compared to there? You're up mildly, you're up 30%, and you're still below pre-COVID numbers. If you are on the less affluent side of the spectrum, you are up much more than that, and you're well past where you were pre-COVID. Okay? So I think that the timing of all this is a little bit different. I think that the less affluent side of the spectrum peaked a little bit sooner and has come up a little bit sooner, and maybe prime borrowers are still sort of in that schedule somewhere. So, and then I think the second component is we've largely, to us, it's not just it's the rate of change of things and the very sudden changes in the delinquency trends in our core borrower, we've sort of caught up to, and we're making significant conservative assumptions about the future. So I think we're expecting further degradation in loss trends. But I think that the difference is compared to like mid-2021, when everything was rosy and everyone still had a lot of stimulus in the bank account and delinquencies were still like 50% of long-term normal, we're now projecting it and prepared for it. So there is still a world in which these vintages underperform going forward, but it would have to be a very, very significant economic sort of setback in our view. And so what we really care about demonstrating to someone who will be forward committing capital in a sort of a cross-cycle kind of a way is, like, what's the cycle of the returns? And if you look at the sort of returns that we, by cohort that we talked about in the investor materials, you can see that it's sort of troughed with the Q3, Q4 vintages. The Q1 looks like it's sort of working its way back. And I think that you'll see that when you see those Q2 numbers, our belief is we will be able to tell a story that the returns have gone through their cycle and we're on the front edge of what's coming. And of course, you can never fully predict the future, but just the preparedness of our models and the conservatism of the macro assumptions are such that I think we're ahead of the curve now. So that's the question with, so that's the answer to the first question. I think your second question was about balance sheet usage. So I don't know, Dave, do you want to chime in on that?
Yeah, sure, Nat. And Nat asked, I don't know exactly how to put it, what's with the back and forth on balance sheet usage is maybe the short version of it. But, Nat, look, I'd just say, we're as a company I co-founded 10 plus years ago. The thing that's made us successful over the years is being nimble and thoughtful and responsive when needed by the market. And, we certainly have a long-term view that we are a marketplace business, meaning to bring lenders and investors together with consumers, borrowers on the other side. And that's how we view ourselves long-term. Having said that, we came to the conclusion that having a sort of a litmus test that thou shalt not use the balance sheet at all doesn't make sense, particularly when you see reaction to the supply side of our business happen in ways that almost look contrary to facts to us, meaning credit's generally performing well. And yet for reasons, that are obviously many of which are beyond our control, lenders or investors take decisions that they take. So I just think in the interest of our shareholders and everybody else, it's prudent for us to use our balance sheet wisely. We don't intend to become a large balance sheet lender, but at the same time, we think it's important to state to the community out there that we're going to do the right things for the business, and we don't believe it makes sense to have a sort of ironclad litmus test that thou shalt not use your balance sheet in the marketplace. And that's the conclusion we came to. We think it really is, as we've said numerous times now, a transitional step toward a place where we have committed third-party capital. And that's what we think also represents a significant chance to upgrade our business structure. And so put those all together, and we think this is the right step forward for Upstart. It's going to be part of building a much larger, a much stronger Upstart over time.
And we will go next to David Chiaverini with Wedbush Securities.
Hi, thanks for taking the questions. The first question is on the take rate, and it makes sense to increase the take rate in this environment. I was curious, how high should we expect the take rate to go over the next couple quarters?
Yeah, hi, David. It's Sanjay. I think maybe one way of putting this is, given the guidance we've put out for Q3, you might imagine that we're doing all that we can to ensure that our P&L remains resilient.
Got it. And then somewhat similar question on originations for the third quarter. I guess zooming out back to the second quarter, are you able to share what the June origination number was and how that compares to July?
Yeah, we're not breaking out specific months, David. I would say that the trend right now is volatile. So there's no real directionality in our numbers, with respect to June versus July.
Got it. And then quickly on the buyback, can you talk about your appetite from here?
Sure, David. Well, as you know, we have board authorization to go up to 400 million, of which we've used 150. I mean, it's sort of an ongoing equation between where the price is versus what we think is fair value, and now, of course, what other sources and uses of cash, or I guess uses in particular, we might have. And so, there's always opportunities, whether it's buying back the stock and reducing the dilution, or looking at some of the convertibles in the market that are ours, or buying loans, which, as Dave said, we think can have a very lucrative return right now. So I would just say that we're monitoring that on an ongoing basis, and we're certainly interested in making efficient use of our cash balance on behalf of the shareholders.
Thanks very much.
Thank you, David.
And now I will turn the call over to Dave Gerard for any additional or closing remarks.
Thanks all for being with us today. Sanjay and I just want to make clear, we're not happy with our results. We're not a company that likes to have a declining revenue from one quarter to the next. But we feel doing the right things to make the company as strong and as powerful as it can be in the future. We are as committed as ever to the mission of improving access to credit for those who deserve it. And we are making steps to make the company stronger and better, and do anticipate we'll be back on a growth track. So we appreciate all of them sticking with us through this, and we're going to get back to work at making UPSTART the great company that it is.
And ladies and gentlemen, this concludes today's call. Thank you for your participation. You may now disconnect.
All right, guys. So we do have a crypto show starting pretty soon here. So stick around. We are going to go straight to our crypto show, which is going to start right now. So yeah, y'all stick around. Our crypto show is going to be starting pretty soon. Let me make sure I can get it set up here. Hold on 1 second. Let me make sure we get this rolling here. Bear with me for 1 second, team. Trying to get to our crypto channel with redirect. And again, once you get to the crypto channel, guys, I do ask that you guys hit that subscribe button, hit the notification bell. We certainly appreciate it. And yeah, we're going to go move on to our crypto show. Again, we're going to move over to that show, talk about some of the latest crypto news in the markets, team. And so again, don't forget to hit the subscribe button. I genuinely appreciate everybody that joined us for today's show. And yeah, again, guys, we're going to go right on over to our crypto channel as soon as I get this set up. We're lagging a little bit. And there we go. And yeah, we'll see you guys over there. Yeah. All right, guys. So we're about to start our crypto show. Let me go ahead and end this stream. Now that we got this set up, bear with me, guys. It's kind of running a little bit slow here.